Netweb Technologies is at the heart of an AI infrastructure surge, and the Q3 FY26 earnings analysis reveals a massive triple-digit growth story and a strategic pivot for the company. We are looking at how this specialized player is shaping the future of high-end computing in India. This was a record-breaking quarter for the company. Netweb reported revenue of 804.93 crore rupees, a staggering 141% jump year-over-year. Profitability followed suit, with net profit rising 146.7% year-over-year to 73.31 crore rupees. This pushed earnings per share to 12.94, more than doubling the 5.55 reported in the previous year. The most significant takeaway is Netweb's successful transition from traditional server manufacturing to specialized AI infrastructure leadership. AI systems now account for 64.2% of their total revenue. To put that in perspective, this segment represented only about 7% in previous periods, marking a complete evolution of their business model. How did they achieve such a massive quarterly beat? It was driven by a single strategic order of national significance worth 450.39 crore rupees. This one order alone accounted for more than 50% of the total revenue for Q3. It proves that Netweb now has the scale and capability to handle massive, high-volume projects. Looking at the flow from revenue to profit, Netweb is showing immense operating leverage. While revenue hit 804.93 crore rupees, EBITDA reached 97.95 crore, growing 115.4% quarter-on-quarter. Even with lower margins on large projects, the efficiency of their operations allowed PAT to climb 146.7% year-over-year. There is a trade-off between volume and rate. The EBITDA margin for Q1 FY25 settled at 12.2%, which is down 75 basis points year-over-year. This is because high-volume strategic projects typically have lower margins than niche orders. However, management has accepted this to secure massive absolute profit growth. Financially, Netweb is in a very strong position, boasting what they call a fortress balance sheet. They have zero net debt and actually maintain a negative net debt position. With a cash surplus of 190.08 crore rupees and negligible finance costs of just 2.89 crore, their asset-light model allows them to scale without an interest burden. To manage the high-value components required for AI, such as GPUs and CPUs, Netweb has updated its inventory policy. They shifted from FIFO to a moving weighted average cost model to better handle price volatility. Currently, inventory levels stand at 149.20 crore rupees, with a minor retained earnings adjustment of 0.427 crore following the policy change. The business stands on three pillars. First is AI systems, the primary growth engine contributing 64.2% of revenue. Second is high-performance computing, or HPC, which provides stable demand from R&D labs and government entities. Third is private cloud and HCI, a growing segment as enterprises migrate from public to private cloud environments. The investment thesis for Netweb is built on three strengths. They are India's top domestic OEM for high-end computing. They are a direct beneficiary of Make in India policy tailwinds and projects of national significance. Finally, they offer a rare combination of triple-digit growth paired with a debt-free balance sheet. Concentration risk is high, as relying on single massive orders creates lumpy quarters. The business is also working capital intensive, requiring 669 crore rupees for materials up front. Additionally, large government projects can continue to squeeze margins compared to smaller niche orders. The final scorecard gives Netweb a constructive rating. They're successfully capitalizing on the AI boom, and the volatility of these lumpy quarters is simply the price of achieving triple-digit growth. The key thing to watch moving forward is their ability to execute the future order pipeline while maintaining steady margins. Follow us at ZinvestZ for more such smart investing insights and deep dives into the companies shaping our technological future. Thank you.